are just around 8 basis points, climbing despite all of the concerns. Now, Marvin Barth of Thematic Markets weighs in on what the bill could mean for the economy, because, of course, this has been concerns over the tax bill coming through D.C. He writes, quote, "The big, beautiful bill, if passed in similar form by the Senate, will further cement the unsustainability of the U.S. fiscal path, increasing the fiscal deficit to a whopping 8% of U.S. GDP in 2025 and 7.8% in 2026. Marvin Barth joins us now. He is the founder of Thematic Markets. Marvin, so wonderful to see you. And look, this is a bond market that so many people have said maybe could be the thing that reins in what's happening, but it's been an orderly sell-off. And under 10 basis points, is this the market saying that we are fine, giving Congress the green light to go ahead with this tax bill?
Well, Danny, it's a great pleasure to be back with you. I think markets are telling Congress and all of the American people that actually you are at the end of your ability to continue to run these deficits at will. This has been going on for more than a decade now. We're just putting a capper on it at this point. And it's shocking that term premia hadn't risen more. In fact, much of the rise that we've seen is really just an adjustment of the negative term premia we built up over the last decade. It's certainly still well below what we saw in the 80s and 90s. So it's not to threatening levels yet, and maybe that's why, to your point, markets are quite orderly, but it certainly is a warning shot.
But will it get to that, Marvin? Will it get to threatening levels? Or is it a bond market that's going to let Washington, D.C. get away with it?
I've always had this view of the U.S. as those old Wile E. Coyote cartoons where, he's running off the edge of the cliff, and only after he's well over it does he realize that it's a straight drop down. Unfortunately, I think that's going to be the situation, Danny. But before that happens, I think a lot of other countries are going to get run off the cliff. Whether you like it or not, the U.S. still is the anchor of the global bond market, and everybody else comes second. And we're starting to see that in markets, whether it's in Europe, where curves have also steepened very dramatically, or most dramatically in the long end of the Japanese bond market.
Marvin, I think that part is so interesting. But how do you judge what is the push and what is the pull, whether it's all coming from the U.S.? In the case of Japan, they have their own monetary woes to deal with the BOJ that's pulling back from a bond market with a lot of issuance after owning 50% of it. We learned in prior instances that the carry trade and what happens in Japanese rates has big global ramifications. Is some of that possibly going on here, too, as it relates to the U.S. bond market?
Well, there's definitely a lot of carry trades that are being unwound. You don't have this type of movement in global rates markets without some sort of existing carry trades being unwound. And we're seeing that across different markets, to exactly your point, in different parts of the curve. I think the key point here is the one that you started with, that it does continue to be very orderly, and at this point we should at least take a lot of solace in that. That won't always be the case if all of these governments continue to try and fund large fiscal deficits, which, by the way, given that everybody's talking about raising defense spending, is actually likely.
Marvin, just to the point of the big, beautiful bill we're going to get, just how stimulative do you see it being?
Well, I think this is one of the things that markets really underestimate. And in fact, I think markets have been far too pessimistic on U.S. growth anyway. Everyone hears these broad tariffs and they think this is going to be a disaster. It's going to be terrible for growth. I've done the number crunching on this. It's actually not that bad. The tariffs, even if you assume full retribution and the worst of the Liberation Day tariffs, you're really only talking about subtracting about 1% from U.S. GDP, just to give you some perspective there. What this bill does, because those tax cuts are very front-loaded in the bill, it actually adds 1.6 percentage points of GDP of tax cuts. And that has a fiscal effect that I estimate is about 2.5% in this year and next year. So this is actually a big boost to growth, even when you take account of the spending cuts that are embedded as well, which unfortunately aren't that big.
So I guess, Marvin, what I'm trying to understand is if this is a big boost to growth, but it's also flashing an amber, maybe later a red light for the bond market, is this good or bad for risk assets?
Well, that's a really good question, but I'd separate the two different effects that are going on here, right? I think the key point is absolutely, this is a tremendously bearish bill for bond markets across the whole curve, right? Because you're getting a powerful growth effect, which means that actually the Fed is unlikely to cut this year or next year. In fact, the next move might be a hike. So you have that weighing on the whole curve, but then you do have this term premium aspect at the end of the curve. That's the part that's negative for risk assets. And so that's why you're seeing these back and forth movements in stock markets.
Marvin, I just want to end on this. I want to get your thoughts on it, because I noticed this in your research that I think many of our viewers would be interested, that you do expect President Trump to push through higher tax rates for the upper income earners. Why do you think that?
Well, I think if you look at even this tax bill, it does actually push through more cuts for lower income earners. You know, you've got the main tax cuts are for tips for overtime earnings. Those are capped, by the way, for higher income earners. You have more income for seniors. And he's actually recently broached the idea of raising taxes on the highest income earners. And if you listen to Steve Bannon, who many think is the sort of intellectual architect of the whole MAGA movement, he really is talking about raising taxes on the rich a lot. This is a conversion of the Republican Party from the party of capital to the party of labor. That is what Donald Trump represents, and I think a lot of people miss that point.
Marvin, this has been a masterclass. It is always a pleasure.